radio for a really great future. We're talking real money.
Hello again. Welcome to another exciting, well, for a money talk show, it's exciting anyway. Not generally exciting. It's actually money, kind of boring. Okay, never mind. Welcome to another boring episode of the Talking Real Money radio show / podcast. I'm Don McDonald, along with my co-host, Mr. Tom Cock, still in the laundry room, but for a limited time only. Limited time engagement in the laundry room.
Yeah, we did have somebody outside the window before the show, so I got fans that are just walking by.
That was your wife, sir.
Oh, okay. Well, she's
a fan, sort of. You know, sometimes she's a fan.
It's the first time anybody's ever appeared there.
Depends on how nice you are. Apparently you were nice today, so she was a fan. She waved. 855-935-TALK. That is a very important phone number because that's the number that brings you here to us to talk with us about your money stuff, which is our best, favoriteest thing to do on the shoe. So give us a call. Didn't rhyme at all.
Waiting for AI to have fun with this one. So good luck.
Yeah. Transcripting. What else was I going to tell you? Oh, I know what I'm going to tell you. Here's the thing. This is fascinating. When you buy or you invest in a mutual fund, what is your expectation?
You're going to make money.
I think that's a fair expectation. Now, sometimes if you take a great deal of risk that you might lose money, but you don't really think you should. I don't think you expect to lose money over a decade. Generally speaking, over a decade, most funds have done pretty well. Even the more aggressive asset class funds. What would you say is the most aggressive equity asset class?
Oh, class or type of fund? Because there's single stock exchange traded funds
a class.
Now.
Like
There's
I would
leverage.
say micro cap.
Yeah.
Very aggressive. That's smaller
Emerging
than
market
small
value,
cap.
maybe.
Okay. The dimensional fund, U.S. micro cap fund,
which
over
been
the
around
last
a long
10
time,
years, it's been around for a long time. Over the last 10 years, has had a total return of 7.6%. There's some bad years, some good years. 2018 was terrible. 22 was terrible. So far, this year has been terrible, but still a positive return. However, there are some funds that you got to wonder why people get into them.
Yeah, you really do. And most people get into these after they've gone up. This is the reason that they destroy so much wealth. I'm going to do the fund families. I'm going to let you do the funds because these are the top 10 value destroying fund families.
I only know one of them, by the way. I truly know two of them. I know two
most people are going to know the first one.
Yeah.
Because if you got on board the ARC, it sank right off the ARC funds.
Now, this is all the ARC funds together, the group.
All combined. Because most people know the ARC Innovation Fund, and they've got others. But they have destroyed the value of $13.4 billion in the last decade. Now, didn't there used to be a show, America's Biggest Loser or something? I mean, they need their own sitcom of some
The Biggest Loser, but it was about weight loss. Really, not about money loss.
That. Yeah. Crane shares down $6.5 billion. Barclays, $4.3 billion. This is 10 years of wealth destruction. Advisor shares down 2.7. Global X, 1.7. ETF managers, 1.2.
These are billions of dollars.
Billions, pardon me. Amplify just under $1 billion. Brookfield, $750,000. And the LJM funds down, which I do not know, a mere $606 million.
But how about
10 years?
Well, yeah. How about this one? Here's a single fund that over the last 10 years, I don't even know how this is mathematically possible. Over the last 10 years, they have lost an average of 50% per year.
You end up with very little money after 10 years.
50% per year. They have 1 year, 2020, where they lost 86% in a single year. The reason they do that is because they are short selling. So it's a fund that nobody puts their money into long term. They put money in for a little while. They're making a bet against the QQQ. So that one's a little extreme, but I just thought the 50% loss was fascinating. Oh. Now, ARC Innovation is the number 3 biggest loser, but I want to go down to the bottom of the list because there is a message in the very last fund on this list of funds. 15 value-destroying funds from Morningstar. This one is going to really shock you. 855-935-TALK.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
Really important. You got to get this right. And one of the ways you get it right is avoiding a lot of the problem children. I've always said when people say, well, how do you pick the best investment? I don't know, but I do know how to pick better ones, and that is by eliminating the bad ones. Eliminating those things that have a history of losing money.
Yeah, the big losers are, they consist of volatile and specialized categories, leverage, inverse trading, the stuff that you really shouldn't be touching, period.
Yeah. I mean, one of them is a short-term futures fund on the VIX, the volatility index. You've got ARK Innovation. You've got a China Internet fund. Okay, wait.
Never miss that, sure.
Yeah. China Internet, there are stocks.
But you've got a surprise there on the list that was shocker.
We've got genomic, we've got global bonds, which short selling funds. Brazil, that's an emerging market. That was a dangerous one. But here's the one that really surprised me on this list from Morningstar. It's the
Remember,
Fidelity.
This is 10 years, right?
10 years.
Wow.
Top 15 value-destroying funds over 10 years. The Fidelity. Now, you're thinking actively managed, maybe? Yeah, could be.
Yeah, of course.
No, Fidelity Series long-term Treasury bond. Must be active managed. Index. Wait, it's an index fund?
This is buying and holding long-term treasuries.
Buying and holding long-term treasuries. Now, This is something we haven't explained as well as we should. We suggest you avoid long-term treasuries. Here is a perfect example. If you had put 10,000...
Now, when you say long-term, what does that mean, by the way? What are you talking here?
Oh, let me go here
What's
to
the duration of the security?
The effective duration is 15 years.
That's pretty lengthy.
That's pretty lengthy, given that BND is, hold on, I'm going to get the exact number.
Under 10.
Six.
Okay, yeah.
So much shorter
difference.
maturity. The Fidelity long-term bond fund over the past 10 years has lost its investors about, if you were in it the whole time, about $2,500 on $10,000, about a quarter of your investment. Bye-bye.
That's surprising, though. You wouldn't think that
they had one year
fund
where they were down 25%.
I bet that was 2022.
Yeah, whereas in the same year, in the exact same year, BND was down 13.
About 12.
Yeah, 13.
Okay, close, yeah.
So
but let's explain why. That's important.
Yeah.
Very. Go ahead.
Because you want to do it? You can do it.
No, why? I want to see if AI gets all this right. That's why.
No. Actually, we should each do a word.
1, 2, yeah.
Yeah. No, that wasn't what I meant. Here's the deal. We suggest bonds in your portfolio for their relative stability. However, long-term bonds have not proven to be stable, and there's a very good reason why. They mature. In fact, there are some bonds in this portfolio that mature in 30 years. So
that's a long time to wait to get your money.
If you put $1,000 into a bond today, you have to wait 30 years for it to be guaranteed $1,000 back to you. In the interim, if interest rates rise, the value of that bond to a new investor is going to be lower because it has a lower interest rate on it. It has a lower rate.
And the people that hold the longer term bonds, those bonds are going to be worth less because new rates are going to pay people more. Why are they going to want to own your bond?
Why would they want your lousy little bond that's paying 3% when rates are 4%? So you got to discount your bond to make the effective return to them if they hold it to maturity, that 4%. So that's why they fluctuate so much. And this is why we suggest steering clear of long-term bonds as the bulk of your portfolio. Now, when you own BND, you're going to own some long-term bonds. But the fact is have so many short-term bonds that they can buy new bonds as they mature at the new higher rates. And let's see, their long maturities are 10 plus years. 10 plus years is
trying to find it here.
10%. Okay. Right about 10. So 10. I forgot to look at the lower quality. 10, 11, 12, 13, 14, about 18% maybe.
Okay. Because they call themselves an intermediate term bond fund, they're paying 4.4%, and very cheaply. So, but yeah, thank you. It's a great lesson. Really is.
I was just shocked when I saw it. I went, wait, a Fidelity bond fund is one of the 15 worst? That shocked me. And by the way, their expense ratio on that fund, 0. It's another Fidelity.
Well, this is one of their freedom.
This is one of their free funds. Yeah.
Okay.
Free fund, but it costs you. So beware.
They're not charging you to lose money. Yeah. Okay.
855-935-TALK is our phone number. Call us. Let's talk about your money. And, wow, Tom, you're out in Duval now, so it is a ways from home. Let's go to Bellevue, shall we? That's in Washington. Carol, welcome to the show.
Hi. I just have a quick question, well, maybe 2 quick questions. Which is better to have about $20,000 in? Is it a high interest checking account or a money market account?
So this is money you're going to use sometime in a short period ahead of us.
Possibly, yes.
Yeah. So you said, I think a money market I heard, but the first one I wasn't sure.
Money market or high yield savings?
Wow. That's, you say tomato, I say tomato. Yeah, I don't think there's a whole lot of difference.
Yeah,
there.
Actually, the high yield savings is inherently slightly safer because it carries direct government insurance. A money market account can and has one time in history fluctuated and been worth less than $1.
Broke the buck in 2008,
Broke the buck in 2008. Yeah, one fund, I believe it was. But it's still very safe.
Either one you're going to be fine with. They're going to pay something similar in today's world as well. So.
Okay. And the other question is, how much money should you have in your checking account instead of
where are you going to dinner tonight?
In savings?
You got any big?
Are you taking Tom?
I wish you were.
I'm having a stove.
No.
I'm having a stove for frozen dinner.
That's the way I eat.
I'll be right over. Yeah,
I'll probably get a P.F. Chang frozen dinner out
I'm going out to a nice dinner tonight with my son. So
yeah, because Tom he's richer than us. He's richer than us.
It's something my mom used to make. It's called ever heard of shit on a shingle?
I don't know that we can say that on the show.
You said sit on a shingle, didn't you? Yes, she did. She said, okay. I'm making that real clear. She said sit on a shingle. Yes, it's chipped beef on toast.
Yes, I know what it is.
Yeah.
We're old. Hey, we're old. Carol,
now I forget what your question.
Older than you.
We're old people. She asked how much money should you have in your checking account, and I can tell you, not much. I tend to keep about a month's worth of expenses in my checking account.
I don't even do that.
I keep about a month because then I don't want to have to think about, and just in case something were to happen, I don't want to have to think about the need to replenish, and it replenishes through my paycheck. So,
right.
We're still getting paid every 2 weeks, believe it or not, for this. No, here's the thing. I don't keep much, but I have kind of emergency savings in another account I could transfer in there if I needed it. So that's why I don't keep much.
Right. Yeah. Well, you said a high yield savings is a little bit safer, but those are all online, right?
Almost always. Yes, ma'am. There are some brick and mortar banks that have a higher yield savings account. Higher. But you need to be very careful. One, I've shopped some of those for my homeowners association. We can find a place to keep our cash, and we have to keep it at a local bank. And I found that those run in the 3s, whereas I can get 4 plus online. And the other thing is you've got to be really careful because they don't want to tell you about them.
Yeah, the high yields, by the way, are FDIC insured, but you have to be knowledgeable or whatever. You can't be inconvenienced by the fact that everything's online. You can't go there and see your money.
Right.
You can't, like you could, like you could go into the vault and see your money anyway.
Hey, that's mine right there.
Right. Well, if you have your money in a brick and mortar bank like BECU, just for an example, and you have your that's where your money market account is, then that's FDIC insured if it's in a bank, isn't it?
Not at a credit union. They
have a different
that's a different insurance. FDIC is a regular bank.
Yeah.
Okay.
They have their own method of insuring those deposits.
All right. And just by the way, I used to work like a block away from your appellate office in Bellevue.
And you never came to visit? Darn.
Kind of hurts my feelings.
Yeah, Tom's hurt now. Thanks for the call. We got to run. We'll be back in a minute. Give us a call, 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
855-935-TALK is our phone number. That's 855-935-8255. You can also send us questions. It's really easy to do that. You just go to our website, which is coincidentally talkingrealmoney.com. There's a little button that says contact us. Every website has one of those. Just find that. And then you can type it up or you can speak it. And we'll get those answered in a future podcast. Today, we do the type 'em up questions, which Tom is he's the keeper of the typed questions right over there.
Because I like paper. By the way, do you know the number of bonds? The number of bonds in BND, the total bond, that surprises me.
It's a lot. It's like 13,000 or something, isn't it?
That's 11,300. That's a lot of bonds.
A lot of bonds.
Diversified. And they turn it over by a third every year, it says here, 36%. I mean, so they're buying a lot of new bonds. So you're getting the higher rates. That's why I was surprised when you mentioned it on the podcast yesterday that it was already paying out 4.3. Because they still own, other stuff that's paying out less.
Yeah.
But they got the new stuff. So I'm assuming you want one of these questions. That's why you brought this up at this moment.
Unless you don't want to share one.
Okay,
it's
totally I prefer
fine.
not. I'd like to put my feet up and read the journal. Actually,
you do whatever you
really
need
appreciate
to do, Tom. You just have a nice time, sir.
In that room.
Yeah. I'll just hang out with you guys. We'll just chat once you call me.
All right, Will writes us from Bangor, Maine. Hi, Tom and Don. I'm 1 month to 4 years from retirement as a federal employee. I don't know what that means, 1 month to 4 years. I guess you and I are in the same spot. My current TSP allocation, 25% in the I fund. I think that's international stocks, right?
That's the international fund. Yep.
25% in the S fund, which I think is smaller U.S. companies. 50% in the C fund, which I think is larger, like S&P 500, correct?
Mm-hmm.
I'm looking for some reassurance here.
Yes.
Okay.
Mm-hmm.
Yeah, I thought so. It says I'll have a military. Thank you. A military and FERS pension and Social Security. My wife will have a state pension, which will equal what we're making now. Great. TSP money totally for living the good life and a little legacy. Is this a decent mixture for our situation? As some C&S funds seem to be invested in overlapping industries. So 25% small, 50% large.
We don't care about industries. We never care about industries. Of course, there will be overlapping industries, but there will not be overlapping equities. You will get the smaller companies in the S fund, and you'll get the big guys in the C fund. So
I love this portfolio. Actually, 50% large, 25% small. I would go a third if I was really getting pushy, but you're okay.
Or I would go 50, 25, 25.
Which 50?
I don't know.
Oh, 50 U.S. large. Because here you're 75% U.S., 25% international.
Well, no. I'm sorry. I would go. International. I would like to see more international. So I'm trying to adjust my figures. 50.
Well, you just
total.
go 30.
I meant 50 total.
Divide
US.
it by thirds.
Well, but there's 4 thirds.
No.
No. It's only
I fund, S fund, and C fund. I just put a third in each one.
Yeah, you're right. I like your idea.
Boom. You're done.
My brain is broken. All right, there we have it.
Broken brain.
855-935-TALK. I do remember the phone number, 855-935-8255. We'll be right back.
Tom and Don are talking real money. Reality radio for a really great future. We're talking real money.
Come on, money trips you up sometimes. It really does because, well, for a number of reasons. One, because there are a lot of people out to get it. I mean, money's what drives most of the stupidity in this world. Money and power, but probably more money than power. And you, because of your emotional makeup, make bad decisions. We know we all do. So we want to help you avoid those things and guide you down the path to hopefully a little bit better financial future. We can't fix all things, but we can fix some of the money things. Give us a call at 855-935-TALK, 855-935-8255. I'm Don McDonald. Tom Cock, his final appearance in the world-famous laundry room. And that's not just a fake stage name. It's an actual laundry room. This is not like Harrah's laundry room at the casino. No, it's
wouldn't that be
real
nice?
laundry.
Yeah, sure.
Tom is performing tonight in the laundry room. So give us a call.
Real place.
855-935-TALK.
Yeah,
Bellevue, Washington. Wait, I'm going to Bellevue.
Yeah, we're going. Okay, go to Bellevue.
I'm going back to Bellevue.
I wanted to talk to you about peace today. So go ahead. Yeah, go.
All right.
Bellevue.
You don't have to go to Brad if you don't want to, but
no, let's go to Brad.
All right, we're going to Brad. Brad, you're up. Welcome to the show.
Hey, thanks for having me. I got a question. So my wife and I have worked for a good 30 years. We've invested through our 401ks and have built up a pretty good retirement fund. We're both in our mid-50s. We recently inherited about around $650,000, so we're very fortunate. What are your thoughts on where we might best invest that? And the reason I'm asking is the majority of our retirement accounts are invested fairly aggressively in growth funds. And so thinking about this more of a kind of a safer, but, still grow, but in maybe perhaps not as an aggressive.
I know what Tom's going to do.
Wait, make money,
I know what
but less
Tom's
risk,
going to do.
Right? Yeah, you know what I'm going to do. Okay, Brad, I got to say it, though, but here you are. Did you say 53, early 50s?
Mid-50s.
Mid-50s, yeah. All right, mid-50s. So, and work
another
10 years, 5 years? You tell me. How many more years?
Yeah, we're in a pretty good spot. I think ideally early 60s would be a good place to retire. If we can make it all work. Was like the film I saw yesterday afternoon, I would start singing about a plan. You really must have a plan, something like that. Because
you went to see Snow White with the kids.
I loved it.
Did they sing about financial plans?
No, they didn't. But if I was there singing, that's what I'd be doing.
You would be writing a song about a plan.
Yeah. So I
knew Tom was going to say a plan. You need a plan. You got to start with a plan because you're starting at the end. This is the worst place to start. Like one of the famous musicals, let's start at the very beginning. It's a very good place to start.
Actually, there was a song in there called Princess Problems, which I now sing to my daughter, which I love. Which she does not appreciate. So, okay, to go back. So here's the thing. You have the money that you've saved in your 401k, the money your wife saved in her 401k. Terrific. Then you have this inheritance you're adding in at $650,000. That should be all looked at as one solid big portfolio, which is trying to do two things, trying to grow some, right? Because you still want to grow. You're going to add to the other stuff. You want to keep it growing for the next 5 to 10 years. And you want to do it with the amount of risk you want to take overall. So it shouldn't be looked at as a different portfolio. What it should be looked at as part of the other portfolio. And by the way, it may be managed a little bit differently because it's going to be, is this all in like brokerage account or is it, inherited IRAs or things like that?
No, it'll be in a brokerage account. Mm-hmm.
Yeah. So it could be managed a little bit differently because for reasons of taxation, but otherwise it would just be part of the overall makeup of your household portfolio, how it fits into all that and then invested that way.
Yeah. And that's where we're going. We're in the process of building a plan. We've engaged with a financial planner. It's just taken us a while to get there, but, thank you. That's consistent with kind of what we've been thinking about. Can I ask you one quick follow-up question?
Yeah, sure.
So what are your thoughts on the current political environment and where you see kind of the geopolitical trends just in terms of, managing risk overall, and specifically in terms of our national debt and what you might.
Speaking of Snow White, okay, yeah,
I'm telling you that this is the kind of question that needs a long break before we answer it.
Exactly. Yeah.
So we have to think this one out a little bit carefully, because when we talk politics, we get yelled at a lot.
Tom and Don are talking real money. Your guides to a really great financial future. Tom and Don are talking real money.
All right. So, Tom, you've had plenty of time to think about the questions in your soundproof booth. And now
we're talking with Brad from Bellevue.
Brad wants to know your take on the.
No, that's not what he said. He said, is it, he kind of inferred, is it different now with the politics and with the fact that, and this is a fact.
He wants a
We're now spending more. Well, okay, I'm getting to that. We're spending more on servicing the debt in the United States of America than we are on defense.
He didn't say that.
Yeah, he did at the end. He said, now that we're paying so much for
him over the music.
Yeah.
Oh, okay.
Yeah.
Well,
so
then,
that was a question.
He did say that. Yeah. And okay, go ahead. What do you think?
That's a legit concern. Okay. Yeah. That politics, hate them, hate the whole thing. Don't like any of it. Unhappy with the whole current situation for a variety of reasons. Right? Yeah, it is. So, but here's at the end of the.
Oh man, you lucked out. You so lucked out because his internet went off right then, and it's so unfair leaving me to answer that question because his internet just popped off. I'm not happy. I do believe that the debt service is a huge problem and that we have to do something about the debt. However, I'm a realist. I am a realist. One, I don't believe in conspiracy theories. I don't believe that everybody's out to get everybody. And I don't believe that you can, I hate this when people in government or in politics say, well, we'll just get rid of the waste. Sorry, there's not that much waste. You don't have trillions of dollars of waste. It's just a lie. But it's a great lie because it assuages people's concerns about the debt service. See, they kind of go away. Here's the thing. You want to cut the federal, let's just talk federal, because I can get into state stuff too. You want to cut the federal budget deficit? You've got to increase revenue. You at this point, that's the only solution. I know. Oh my God, he's a flaming liberal. I'm not. I'm a realist. I'm a pragmatist. You have to somehow find more income because the biggest chunks of the federal budget, and by the way, this was a mistake made decades ago. Social Security should have been its own little bucket, not part of the federal government, because we say, well, entitlement programs cost this much. Well, yeah, when you throw in Social Security and Medicare, which are self-funded, but they're the monies get spent before it gets to the people, or now it will be, before it gets to the people who paid the money in. I know we all get more out than we put in, but anyway, we have to come up with more revenue. That's just the only solution. So we can play this game with ourselves, which we will continue to do for as long as we can. Do I think it will destroy the country? No. Good news is everybody's in debt. So that's been a part of our government and the British government and other European governments since the beginning of time. Does it worry me? A little bit, yes. You went right out as you started to answer the question.
Literally, boom.
Literally, right now. I went, he hung up on purpose.
Yeah, exactly. I mean, so here's the thing. My take is, what would you do differently? In other words, yeah, we are where we are, but what does that mean? In my mind, not much. You still want to diversify your equities.
Oh, you're talking about as an investor. Yep, as an investor.
As an investor.
Absolutely. You can't do anything differently.
No, that's the thing. You could say, well, it's all about X now. People have said that, all about X, variety of times over the years, and they generally are wrong. So no. Yeah.
Yeah. Let's go to Sumner, Washington real quickly. Rosemary, welcome to the show.
Hi there.
Hi, Rosemary.
And thank you for having me. Yes. Thank you for having me on.
It's our pleasure. What can we do for you today? Yes, ma'am. We can hear you.
Oh, okay. I called a number of months ago, and my plan is, although it hasn't been carried out, to have a Roth IRA for each of my granddaughters who are now in college and working, so I can contribute up to $1,000 a year into their Roth IRA if they've made that much, which they have. And I'm just looking so that I'm going to do this every year for maybe the next 5 years.
Great.
To get them.
You're a nice person. I think that's wonderful. Then, yep.
Well, hopefully they will not touch it or even care if it exists until they really need to know. So I have two questions. One is what I want to just put it in set it and forget it. So what funds would you suggest for doing that? I would put each of them
easy.
Into the same
That's
fund.
so easy in today's world. There's a couple, but I would recommend the one that AVGE, the Avantis Global Equity Fund. It's one fund, invests globally, very low cost. AVGE. It's easy. Put it all in that. It's
aggressive, but they're young. It has a whole lot of stocks in it. It is well run. It is low cost. You could do that one, or you could do the DFAW.
Yep, either one.
Either one.
DFAW. Okay,
yes,
that's what
correct.
I needed. And as I say, I'm going to set it and forget it, and just make a contribution and not. And they undoubtedly will not have any interest in playing with it. So I'll just.
That's perfect, because if they don't play with it, for the next 30 or 40 or 50 years, literally with adding nothing to that 4,000 or 5,000 you end up putting in, they could have somewhere between $100,000 and $500,000.
Yeah,
100,000
you will
and
really
$500,000.
You'll get them off to a terrific start, Rosemary. So that's wonderful.
Well,
thanks for doing it.
I'm hoping that is how it turns out. And the other question I have is, and I believe I have till the 15th of April to get this all set up. Is that correct?
That's correct.
Year?
Yep.
Yes,
for
ma'am.
tax year 2024. Okay. That's right.
All right, because my daughter is supposed to be setting those up, and that's what I told her, but I wanted to make sure I wasn't telling her a fib. So
still got about a month,
that's all I needed
3 weeks.
You're doing great. Thanks for the call. We appreciate it.
Super.
That's heartwarming.
All right, thank you both.
Thank you. Take care. We're going to go back to our friend in Ottawa, Canada. Jeff, you're up. Welcome to the show.
Hey, guys. How are you?
Good, Jeff. What's up?
I'm going to motor through this really quickly because I know we're at the end of the show. I just want to get your guys' opinion on my portfolio, the ETFs that I have. It's a little bit of a twist, though, because I have a Canadian dollar account and a U.S. dollar account. It's in, I guess, what would be a 401k equivalent up here. Mm-hmm. It's called an RRSP.
Mm-hmm. Yep.
Okay, so in the Canadian account, I've got 50% in what would be the equivalent of VOO, but it's just a Canadian fund.
Wait. Okay, but is it the U.S. S&P 500?
Yes.
Okay, good.
Oh, okay. All right. Yep.
Yeah. 20% in VVL with global value factor. 20% in developed all cap, excluding the U.S.
Got it.
And then 10% in emerging markets.
Good.
Again, it's in a fund.
That's fine. That's good. Nothing wrong with that.
Yeah, okay.
No, that's great. Yeah. You've got large cap growth. You've got value. You've got developing. You've got 30% in international. So that's good.
That's pretty good.
And you don't have a major portion in Canadian stocks, which is great.
Yeah, I think it's just covered through the developed cap.
It is, and
I suppose.
Yeah, and people overinvest in their own markets. Now, let's look at the other one after a quick break. We've got a couple minutes after the break that we can spend on your U.S. portfolio, but this one sounds terrific. And remember, every Saturday you can call us wherever you are, whenever you listen at 855-935-TALK.
Tom and Don are talking real money. For your real life and real future, Tom and Don are talking real money.
All right, we're going to go back over to Jeff in Ottawa, Canada, and your portfolio. Do you want to know what it looks like? And this is the U.S. denominated portion, right?
Yeah. What do you got? Hit us.
Yeah. So first, I should say when everything's converted into Canadian dollars, the whole portfolio is 3/4 Canadian and 1/4 in U.S. dollars.
Okay.
My U.S. account, I should say, if that makes sense.
Mm-hmm.
Yeah.
All right. So for the U.S. dollar account, 50% VOO, 30% VU, and 20% VBR. Yeah, they're all Vanguard funds. And yeah, so that's the U.S. account.
VOO, of course, is U.S. large cap. VBR is U.S. small cap value. I missed the one in the middle.
Sorry, so VOO, yeah, the S&P 500 index, got 50%. VEU, all world ex-US. So,
the all world. All right, yeah.
Yeah, and then
I thought you said VU too.
Fine.
I'm going VU.
I wasn't sure what he said. I think those are really good portfolios. By the way, we got to add one thing because you've been kind enough to call, and we kidded you about becoming the 51st state. Frankly, we took a vote, Don and I. We'd rather become the 11th province. We want to be the 11th province of Canada.
Yeah, we decided we want to join you guys instead.
Yeah,
is that all right?
It's the other way around.
I don't blame you guys. Yeah, we're a little bit. I don't want to get into Canadian and U.S. currency exchange and economic.
Oh, that's true. Your currency is worth less.
Yeah, see, that's a whole other question for the show. But
I'd be a whole lot richer in Canada.
Yeah.
You'd have a lot more of the, whatevers. Sure.
I would be. I would not. I was going to say I would not just be loony. I would be rolling in loonies.
A lot of loonies out there.
Yeah. I was in Atlantic City over Christmas, and believe me, it was not fun, the exchange.
Yeah, not for you guys, but hey,
not at all.
If we could,
you're doing a great job on these portfolios.
If we could come gamble in Ottawa, we'd be in great shape. Thanks for the call. We appreciate it.
Love it. Okay, thanks, guys.
Jeff.
Nice talking to you again.
All right, take care. I've always wanted to visit Ottawa. Ottawa's great.
My folks went there and loved it. So
people tell me it's gorgeous, but what do I know? Hey, if you want to ask us questions, again, you can call us on Saturdays at 855-935-TALK, or you can go to talkingrealmoney.com and type in your questions. Those get answered whenever, or speak them in. Those get answered on Fridays. So do that. Go to talkingrealmoney.com. Anything else you want to add there?
And if you want a little more help than just a quick off on your questions, you can talk to myself. You can talk to an advisor. Easy to do that just by going to talkingrealmoney.com. Click on Meet an Advisor. We do free portfolio reviews. We have discussions with you. Some people, they become clients. Some people, we wish them well, and they go off and take care of that matters on their own. So it's either way, but we'll help you.
I want to make sure you really do understand this. For those of you just joining us, this is the God's honest truth. If you set up an appointment with one of our advisors, you're not going to get pushed to become a client. We don't do that. As a matter of fact, some of our advisors go, what? Ones we hadn't worked with in the past, they go, what? You did this for nothing? What? Yep. We're not doing that.
Always have.
We do it for nothing. There's a reason. It's actually selfish.
It works.
It actually gets us clients without being pushy. I don't know. It's the Miracle on 34th Street strategy. You tell them you got it at Gimbel's, and they shop Macy's.
Santa's over there, too.
Anyway, go check it out. Go to talkingrealmoney.com and either ask the question using the contact form, or if you want somebody to sit down and work with you for a few minutes, we'll do it for nothing. Just click on Meet an Advisor.
Expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. I think I need a nap.